Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Welcome to another KULR analysis. This time we're going to analyze the company's stock from a few different perspectives. KULR Technology Group has become a genuine battleground stock as we close out 2025.
It really has. The tension is palpable, and it presents a fascinating puzzle for investors.
Exactly. Is KULR's big pivot into AI server racks and defense strong enough to overcome the massive technical headwinds? I mean, we're talking about short sellers, structural dilution. So the central question is whether KULR is poised for a massive valuation re-rating, maybe that 5x return people are talking about, or if the risks, things like margin erosion, just make the current stock price unsustainable.
And that's where we differ. I think the high short interest isn't just noise. It's a rational signal of market skepticism.
See, I believe the strategic actions by management, especially pausing the ATM offering, have set the stage for an explosive upward correction.
And my position is that the precipitous drop in gross margin, down to just 9% in Q3, signals a deep structural problem. That operational risk, for me, is what justifies the caution.
Okay, well, let's get into it. The core investment narrative for me rests on their ability to scale revenue, and they are demonstrating that. We saw, 116% year-over-year revenue growth in Q3 2025. That validates the commercial pivot. And this growth, it's anchored by the $100 million joint development collaboration, the JDC, which is focused on battery backup units for the AI server rack market. This addresses what some call the energy density paradox, where hyperscalers need just a tremendous amount of energy in a small, safe footprint. It's a problem KULR's tech is designed to solve. But the real game changer, the thing that alters the whole equation, is the suspension of the at-the-market equity offering through mid-2026. For months, that ATM was a constant tap. They were selling millions of shares. Shutting it off removes the dilution threat, signals massive confidence in their $24.5 million liquidity position, and it just transforms the technical landscape into a highly combustible environment for anyone short the stock.
That's a compelling technical argument, I'll give you that, but you can't ignore the fact that the 1,600% rally from the lows has just absolutely outpaced the operational reality of the business. You mentioned the $100 million JDC, but let's be clear, that is speculative revenue. It's an agreement to collaborate, not a guaranteed purchase order.
It's a powerful signal, though.
It's a signal, but that contract carries substantial execution risk. The product has to pass rigorous qualification testing, like the UL 9040A standard. If it fails, or if the partner just decides to dual source the tech to mitigate their own risk, that revenue evaporates, and the whole growth thesis just collapses. And more urgently, we have to confront the margin collapse. It fell from 71% a year ago, back when they were doing high-margin engineering services, to 9% this quarter. That sharp drop is the market telling us the high cost of goods sold is making scaling incredibly difficult.
I see why you're focused on the margins, I do, but let me give you a different perspective on how the trading dynamics really override that concern in the near term. The stock is a classic battleground, and the short position is now its biggest potential accelerant. The short interest sits at approximately 17 to 18% of the free float. What's crucial here is the days to cover ratio, which is extremely low, just under 4 trading days. This setup means that any sustained buying volume, let's say from a press release confirming the first POs for those AI BBUs, would immediately force shorts to scramble, triggering a rapid, violent price spike. The short trade is deeply crowded, and the cost to borrow is well over 7% annually. That's a constant grinding friction. The shorts are paying a significant premium every single day they stay in that trade.
I agree that the short position is tight and it's expensive, but I'd frame that high short interest less as an accelerant and more as a robust indicator of deep institutional skepticism. Shorts aren't betting against the technology itself. They're betting against the commercialization model, achieving profitability at scale, given the cost structure we just discussed. When professional traders look at a stock with 18% short interest, they see multiple failure points, and we also can't just ignore the immediate technical sell-off risk. That 1,600% gain means early investors are sitting on massive profits. Shorts anticipate that profit-taking will create the supply needed to drive the price down. I mean, why would you short a stock so heavily unless you were certain that supply from existing holders would overwhelm any new demand at these levels?
That perspective on early investor supply is logical, but it completely misses the most important point. The supply tap from the company itself has been shut off. That fundamentally changes the free float dynamics. The ATM facility, which was essentially a mechanism for corporate dark pool trading, it acted as a safety valve for short sellers. Historically, when a heavily shorted microcap rallies, the company steps in, issues millions of new shares through the ATM, and effectively bails out the shorts. By pausing the ATM through mid-2026, management has taken away that safety net. Now, if a rally starts, buyers are forced to bid higher against the existing float. The squeeze mechanism is amplified dramatically because the supply is genuinely constrained.
I'm sorry, I just don't buy that the ATM pause is some immediate fix for the underlying volatility. It removes the corporate seller, sure, but the price is still too dependent on the sentiment engine of retail investors. We look at institutional holdings, passive holders like Vanguard and BlackRock give you a floor of about 18 to 20%, but the overall institutional percentage is low. That means the stock is highly vulnerable to these rapid, volatile swings fueled by momentum in social media, not just financial reporting.
But you mentioned the options data, or at least hinted at it. So let's explore that, because it speaks directly to the technical setup. The extremely low put-call open interest ratio, meaning far more calls are outstanding than puts, creates a situation where the market makers who sold those calls, they are forced to buy the underlying stock as the price moves up. This practice, delta hedging, it sets the stage for a classic gamma squeeze. As the stock rises, these professional traders have to buy millions of shares to offset their risk, creating a powerful, self-fulfilling buying frenzy that can dwarf any retail momentum. This mechanical buying pressure is precisely why the constrained free float, which the ATM pause guarantees, becomes so critical. The buying is forced onto the exchanges, overpowering the shorts.
You're making the case for an inevitable feedback loop. But that leverage, it cuts both ways. Technical setups rely on momentum, and momentum relies on news. If that news is delayed, if management pushes back the first PO confirmation, or if Q4 or Q1 margin figures show even more erosion, that gamma leverage reverses instantly. The market makers who are buying suddenly become forced sellers, and you get a rapid, vicious decline. And this brings us back to valuation, because this is the fundamental justification for your 5x potential, and it's where I have the biggest challenge. Okay, let's address valuation asymmetry, because this is where the 5x potential becomes mathematically sound. KULR currently trades at about 8 to 10 times sales. Now look at peers in similar high-growth verticals. Amprius Technologies, they're in silicon anode batteries, they trade around 23 times sales. EOS Energy, grid storage, trades at an astounding 54 times sales. So KULR is being severely discounted. If KULR merely achieves the projected $35 million in 2026 revenue and just re-rates to Amprius's more modest 23 times multiple, the market cap would reach $805 million. This projection aligns perfectly with a 5x return. It's not aspirational, it's mathematically supported by peer benchmarking.
That is a compelling argument using peer multiples, but you're skipping over the margin reality that underpins those high valuations. That 9% gross margin is the elephant in the room. A company that trades at 23 times sales is valued that way because the market anticipates future high gross margins and efficient conversion of revenue into free cash flow. When QLR's got 9% margins, it means $91 of every 100 in revenue goes right into direct costs. They are essentially running faster just to stay in the same place financially. That's the definition of profitless scaling. This high cost base means QLR needs exponential scale just to break even. So I'm just not convinced, because applying those premium peer multiples before management demonstrates a clear, credible pathway back to a 20 or 30% margin range it's just premature. The market is right to discount them until they prove they can scale profitably.
But that's precisely why the IP is the moat. They are solving a critical thermal and safety issue that others cannot. The structural demand for their tech, driven by the AI power crisis and defense electrification, is non-negotiable.
It's a classic low-margin, high-volume hardware play where margins naturally expand as you achieve scale. We have verified growth, and we have a strategically constrained supply thanks to that ATM pause. The whole technical setup, high short interest, low days to cover, bullish options, it strongly favors a sharp price correction upward. The time horizon here is measured in months, not years.
My position remains cautious. That high short interest is a legitimate warning sign tied directly to unavoidable operational risk. The 9% margin challenge and the absolute necessity of converting that $100 million JDC into guaranteed profitable revenue are the critical hurdles. Until management proves it can scale hardware profitably and start showing sustained margin expansion, the technical risk of a severe sell-off remains incredibly high. The valuation story you present only works if the profitability story follows right behind it, and we just haven't seen the evidence for that yet.
It is a genuinely complicated investment puzzle, no doubt. It's sitting right at the intersection of, on the one hand, verified technological superiority, and on the other, this daunting commercial execution risk. The source material shows a real tension. The ultimate trajectory of KULR really depends entirely on operational reporting in the coming quarters, specifically validating margin expansion and converting that JDC. And that leaves the conclusion on KULR's potential valuation entirely up to the listener to weigh the evidence on both the technical dynamics and the financial health of the business.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.